Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I discuss how oftentimes people look back at past experiences and overestimate their ability to understand what is happening at the time. All of the unknowns around COVID-19 gives us an opportunity to reflect on the concept of how much we may not know in the here and now, particularly in times with very high degrees of uncertainty. Thank you for listening. We hope you enjoy the discussion. So, one of the things that we all, I think, fall victim to as investors, and probably just in life in general, is the tendency to think that we saw things coming after the fact. So if you think about investing, whether it be the financial crisis and the housing bust, or maybe the big decline we saw at the end of 2015 when energy peaked, or whatever it might be, it's always easy to look back at those environments and situations. And a lot of people do this and they sort of say, okay, I saw that coming. And you can kind of, the narrative in your mind, because you know what caused it, it's almost like people convince themselves that they would have known or had the knowledge of that before those events or while those events were happening. And it's only until after those things transpired that we actually understand what was happening. And so your article, A Letter to My Future Self, which you've written a lot of letters to yourself.
I know, probably too many.
Yeah, exactly.
At this point.
But that was it, and that's how you started that, which it was a really interesting thing to think about. I don't think people think about that enough, which is, you probably didn't see it. Most people don't, and you have to be careful not to brainwash yourself and think that you saw it. So why don't you just shake out that idea a little bit more? I'm probably not doing a good enough job explaining what
you did a good job. I mean, basically, in retrospect, all of us, whatever ends up happening, like if you take this bear market, for example, whatever ends up happening, we'll look back and we'll say, I saw it coming. Whether we're in a big rally right now, whether that rally holds and we've already hit bottom, we'll think that, we'll look at the positive facts that are around right now and we'll say, I saw that coming. If we have another huge leg down, we'll look at the negative facts and we'll say, I saw that coming. And so the point of my article was, it's not just, a lot of investors do it, but I also do it myself. And so I wanted to write a letter to myself to say, here's what's actually going on the ground right now. Here are all the facts. So when I look back and say, whatever happens, I say I saw it coming, I can realize it was much more uncertain at the time than what I actually think it was in retrospect.
All right. And you kind of built on this. So you started with talking about like the virus and the fact that it's, growing exponentially every day. What's interesting about this is a month ago, like I was not on the side that this was, I didn't see that. I mean, I didn't see this one coming at all, because it was like you heard about this in China and then you heard about it maybe in Italy and then it was like, it's not a big deal. And so, but now looking back, it's like I almost want to say, oh yeah, like I clearly saw it but I wasn't on top of it whatsoever. You were way more on top of it than I was.
Yeah, and most people didn't see this coming. It's hard to, it's easy to look back and look at the facts about what was going on in China and the shutdown of Wuhan and all that stuff and say, all right, obviously it was going to come to the U.S. And maybe that's the case. I mean, if you talk to medical professionals, many of them thought it was going to come. But for your average investor, it was not obvious, what was going to happen. And then if you look at where we are right now, there are a lot of positives in terms of, obviously the virus situation is, mostly a health situation, and we're just going to talk about the stock market part of it. But if you look at it just from a stock market perspective, there are a lot of positives in terms of what might happen with the virus. There are a lot of negatives, and we don't know what's going to happen. In recent days, we've seen some data that indicates that maybe the exponential growth of this is slowing, and, you have politicians are out and, medical experts are now saying maybe we'll be able to open up a little sooner than we thought. But will that change? Will the growth get going again, or will we open up and then there'll be problems because we'll start the virus going again by opening up? Or many people think we might open up and be open all summer, and then in the fall it's going to come back, and so we're going to have to shut down again. So if you think about this and you think about all the potential outcomes for the market, even if you're a medical professional, and most of us aren't, there's a lot of variables in there. And, we may look back after the fact and say, well, I saw that coming, but right now in the moment, we don't see any of this coming because we just don't know. It's far too uncertain. Just before we even get into the stock market, just the medical situation on its own is so uncertain. And the medical situation is what's driving the market at this point. So even though we might look back in retrospect and say, all right, I saw whatever happened with the virus coming, the reality is none of us really see it right now. It's far too uncertain.
So if stocks have actually put in the bottom, which I'm not predicting that, I'm not saying they have, but if they have and, things aren't as bad as some of these models have predicted, obviously the economy shut down. So the market's going to react to, in the short run, it's, a lot of psychology and then trying to figure out what this range of potential outcomes is and how much the shutdown has impacted business and profitability. But if we can get things going back to some degree of like normal operation, quicker rather than later, looking out a year from now, we may look back and say, who knows? Stocks might be up a lot. And I think as an investor, you might look back at this time and say, I thought it wasn't as bad as it was, but yet I don't think you'd be telling yourself the truth because, to your point, no one really knows. There's such a wide range of potential outcomes here. And, investors will, I think, be largely influenced by whatever happens and not necessarily thinking back to, the degree of uncertainty they were in at the time.
Right, and this is not even a financial issue, which makes it even harder. Your traditional bear market, 2008, is very hard to judge when you're in the middle of it. But when what's driving it is a medical issue, now you're even further outside. Even those of us that are professionals with this, we're further outside of our core competency. Because how do we know? I'm not a medical expert. I can't tell you what's going to happen with the virus. But in order to understand how it's going to play out, I have to know what's going to happen with the virus. But I probably will look back 2 years from now and say, oh, I should have known what was going to happen with the virus because, for whatever reason, I'll think that I should have known it in the time when the reality is this situation right now is really, really uncertain. And that's what I was trying to get across is there's so much uncertainty around so many things right now that even if we look back and say I should have known it, you really shouldn't have known it because it's just too complicated at this point.
One of the things that investors might do is look at like valuations. That was another point in your article. And you were kind of making the point that, we're down, but, stocks, there's groups of stocks that look sort of still expensive, and then there's certain groups that look really cheap. And, it'd be easy a year or two from now to look back and say, okay, see, clearly this group of stocks, small cap value, or these energy names or airlines, they were trading at, single digit PEs. If those are the best performing companies, it'll be easy to look back and say, okay, see, I could have figured that out or I knew that then. But, that would have been almost very few people are doing that.
Yeah, there's almost two different things going on here. There's the market as a whole, and when people compare the sort of the 2008 bottom to what we're doing right now, well, the market as a whole, one major difference is the market as a whole is much more expensive than it was, at the 2009 bottom. So, you can't really compare those two situations, and as we're looking at it at the time, that's one reason maybe to be a little less bullish than I would have been, or maybe a lot less bullish than I would have been at 2009. We had historically low valuations then. We might have historically low valuations now on a segment of the market, but we don't have it for the entire market. And so that makes this situation tricky too, because we've had our major decline, but we don't have those rock bottom valuations you typically might want to see coming out of a bear market. So just like the medical situation, the valuation situation is very cloudy as well. So now we've put another layer on top of this. Now, in order for me to look back and say I should have seen this coming, I have to feel as I could have evaluated the medical situation. And now I have to also feel like I could have evaluated the valuation situation. And then on top of that, we've got the economic situation, which is we've now shut down our economy for an extended period of time. We don't, A, know how long that's going to be, and B, know what the implications of that are. And, anybody who says they know that, are fooling you because we've never gone through it before ever. And so it's impossible for us to, properly judge something we've never been through before. So on top of those, on top of medical and valuation, now I also have to judge what is the impact of this shutdown and how long is this shutdown going to last? And so when you pile all of that on, when we look back in retrospect and say, I should have seen this coming, you have to look at these facts and say, this is really uncertain right now. And sitting in the moment, I have no idea how this is going to play out. You may feel like you have a stronger opinion than I do, but it seems very, very uncertain right now.
But let's talk about what the implications are, though, for your average investor, because that's important. I mean, on the one hand, we're saying it's, you don't want to think that, what the outcomes are, or you're going to make these predictions that are going to be right, or that you're going to look in the future, you're going to look back and say you saw it coming. But, in terms of what an investor should be taking away from this, is it just, in investing, given things are so super uncertain in the short term, that really it's always important to take a long-term view, to understand that in the short run, stocks are very risky. I mean, you're rewarded for that risk with hopefully good long-term returns over time, but that's even not over all 5-year periods or 10-year periods is a guarantee either. So let's just try to shake out a couple of the implications for investors when thinking about this type of idea.
Yeah, so it's good to talk about this in theory, but the problem comes when you try to put it into action. And so when you're trying to go back and say, I saw this coming, like if I were, for instance, to look back at the 2008 bear market, and I was to say, all right, I saw it coming. I saw all the issues with housing. I saw the subprime situation. I saw it coming. Now, when I translate that to this bear market, that's where that becomes a problem, because now I become overconfident. Now I say, well, if I saw that one coming, whatever my conviction is now, that must also be right. And so that's where this can be dangerous. That's the actionable part of this is, if there's any lesson of all this, it's to do nothing. If there's any lesson, it's once you have your asset allocation set up, an asset allocation set up that's appropriate for you, you need to ride out these periods. And looking back and thinking, you're smarter than you were can lead you to make big mistakes in the next bear market. And so that was sort of, if there's an actionable takeaway from this, I think that's it.
Okay. So I think that's a good way to sort of end it. We'll put a link to Jack's article to his future investing self in the podcast. So 5 years from now, he can re-listen to this podcast and reread his article. And hopefully you guys got some value out of this. Thanks for listening.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.